Welcome back to the deep dive. Today, we are opening a fresh file for a segment we're calling the AI Investment Memo.
Yep.
Now, the goal here is deceptively simple, but the execution is where we have to really roll up our sleeves. We aren't here to chase the hype cycle.
No momentum trading here.
Not at all. We are going to take a single company, one that is established, one that has history, and strip it down to the absolute studs. We want to figure out if it actually meets the exceptionally high bar for a long-term investment holding.
Exactly. We aren't looking for a quick flip. We are looking for quality. We want to answer the question, is this a business you can own for 5, 10 years? Is it a compounder that will help you retire? Or is it a trap just waiting to snap shut?
And to set the scene, today is Monday, February 9, 2026. The subject of our memo is a company that, honestly, most people probably think of as boring. We are talking about Paychex, Inc., ticker symbol PAYX.
And, boring is often where the money is.
That is very true. It is often seen as the plumbing of the American small business economy. It's reliable, it's profitable, and it is absolutely everywhere.
Ubiquitous.
Right. If you walk down Main Street, chances are half the shops there use Paychex. But, and here is the hook, the stock price has been having a rough time. It is down about 30% from its highs back in 2021.
That's a pretty significant drop for a company this stable.
It is. It is trading near a 52-week low, hovering around, what, $105 per share?
Which naturally raises the big multi-billion-dollar question. Is this a rare bargain for a wide-moat compounder? A chance to buy a great business on sale? Or is it a value trap? Are we looking at a company that is facing a slowing economy and, more importantly, struggling to digest a massive, difficult acquisition?
That is exactly what we are going to find out. Here's our roadmap for this deep dive. First, we are going to dissect the business model. And spoiler alert, it is about a lot more than just printing paper checks.
Tell more.
Then we're going to do a historical deep dive to see how their culture was built and, crucially, how they handled past crises.
We have to look at the history. You can't understand the risk if you don't see how they handled the Great Recession, for example.
100%. Then we are going to evaluate the massive, and I mean massive, $4.1 billion bet they made on Paycor back in 2025.
The elephant in the room.
Absolutely. We'll stress test the financials against a skeptical framework, looking for any cracks in the foundation. And finally, we will deliver a verdict. Is Paychex a great business or just a good one?
Let's get into it.
Okay, let's unpack the business reality first. Section 1, the moat and the economics. The framing question I have for you is this. We live in a world of cheap software. You can find payroll apps everywhere.
They're a dime a dozen.
So how does a company that processes payroll for 1 in every 11 private sector workers maintain operating margins around 40%? That just seems impossibly high for what looks like a service business.
It is a remarkable number, and it's really the key to the whole thesis. To understand it, you have to realize that Paychex isn't just a software vendor. It is essentially an outsourced HR department for small and medium businesses, or SMBs.
So they do more than just cut the checks.
Way more. They serve about 800,000 clients. But if you look under the hood, the revenue isn't a monolith. It's really, I like to think of it as a three-legged stool.
Okay. Walk us through those legs. What is holding this structure up?
The first leg, and the biggest one, is what they call management solutions. This is the core engine. It makes up roughly 73% of their revenue.
And this includes the actual payroll processing, the tax filing.
All of that. And their HR software platform, which they call Paychex Flex. But it also includes something people often overlook. Retirement services.
Retirement services, you mean like 401k?
Exactly. This is a huge part of the business people miss. Paychex is actually one of the largest 401k record keepers in the entire country by the number of plans they manage.
That's incredible. So it's not just for big corporations.
No, think about their typical client. A small dental practice would say 8 employees. They want to offer a 401k to compete for talent, right? They aren't going to call a massive investment bank like Goldman Sachs or Fidelity to set up a custom plan.
Way too expensive and complicated.
It's just too much hassle. They are going to check a box on their Paychex dashboard. It's an add-on.
Convenience is the product. The real product is simplicity.
Precisely. It's bundled. That's leg one. The second leg is the PEO and insurance segment. This is about 24% of revenue. And PEO stands for Professional Employer Organization.
I always find PEOs fascinating. It's basically co-employment, right? Can you maybe explain how that actually works for a business owner on the ground?
Sure. Think of it as a union for small businesses, but for administrative power. Technically, when you sign up for PEO, Paychex becomes the employer of record for your employees for tax and insurance purposes.
So my employees are now technically Paychex employees.
For paperwork purposes, yes. This allows a tiny coffee shop with 5 employees to offer the kind of health insurance and benefits that usually only a Fortune 500 company can get.
So Paychex pools all those employees from all its clients together to negotiate better rates.
Exactly. Because Paychex represents hundreds of thousands of lives, they can go to the big insurance carriers, United, Aetna, you name it, and negotiate massive volume discounts. A small business owner could never get those rates alone.
That's a massive value proposition.
It is. And for Paychex, it makes the relationship incredibly sticky. You can't just turn off a PEO relationship overnight. It's deeply, deeply integrated into your operations and your employees' lives.
Okay, so that's the second leg. And the third thing.
Interest on funds. It's the smallest piece, usually only around 3% of revenue, but it is fascinating. It is essentially pure profit.
Pure profit. How does that work?
Basically, between the time a company sends Paychex the money for payroll and taxes, usually Tuesday or Wednesday, and the time Paychex actually deposits it into the employee's accounts or sends it to the IRS, there's a lag.
A float.
A float. Paychex holds that money. And we are talking about billions of dollars in client funds sitting there.
And they earn interest on that money while they hold it for those couple of days.
They do. They invest it in very safe short-term securities. And in a higher rate environment, that becomes a real tailwind. In fiscal year 2025, for example, interest income jumped 10% just because interest rates were higher.
It's a nice little bonus, a natural hedge against inflation almost.
It is. So, okay, they have these 3 revenue streams. But let's get to the core of it, the moat. Why is this business so defensible? Why doesn't a small business just switch to a cheaper app? Morningstar rates their moat as wide. Why?
Yeah, that's a high bar.
It comes down to one thing, primarily. Switching costs. High, painful, miserable switching costs.
Okay.
Think about it from the customer's perspective. Payroll is mission critical. If your email server goes down for an hour, it's annoying, but you live. If your payroll doesn't run on Friday.
It's a catastrophe. Your employees are furious, and the Department of Labor is knocking on your door. You do not mess with people's paychecks.
Exactly. Switching providers involves migrating incredibly sensitive data, social security numbers, bank details, and setting up new tax codes for every single employee. You have to reintegrate everything. It is operationally chaotic.
And the risk of making a mistake is huge.
Huge. One wrong number, and you're dealing with tax penalties. So the inertia is powerful. Unless Paychex really, really messes up, clients tend to just stay put. It's easier.
And I imagine there is an intangible asset there too, right? Just the brand trust. You're not just buying software, you're buying peace of mind with the IRS.
That's a huge part of it.
Yeah.
They have been navigating tax codes for over 50 years. They operate in over 100 jurisdictions with literally thousands of different tax codes. You have federal taxes, state taxes, local taxes, unemployment insurance. It is a labyrinth.
And if you're a small business owner, your expertise is in, I don't know, baking cakes or fixing cars, not navigating Form 941.
Right. You are terrified of the IRS. You pay Paychex not just for software, but for the implicit guarantee that you aren't going to get a scary letter from the government and get fined.
That makes a lot of sense. There's also something interesting in the source material about how they get new customers. It mentioned a network effect of referrals. That sounds powerful.
This is a hidden gem in their business model, and it's something a new competitor just can't replicate. Over 50% of their new small business clients come from referrals.
Wow, over 50%.
Yes, and these aren't just random referrals. They're coming from trusted advisors, mostly from CPAs, banks, and financial advisors.
So the people who are already handling the business's finances.
Precisely. And that dramatically lowers their customer acquisition cost, or CAC. Think about it. If a CPA tells their client, look, just use Paychex, it integrates with my software and I know how it works, the client just does it.
The decision is basically made for them.
It is. A startup competitor has to spend millions on Instagram ads and Google search to get that same client's attention. Paychex gets them almost for free because they have spent decades building these deep relationships with local accountants all over the country.
That is a massive, massive advantage. Let's circle back to the margins again. You mentioned 40% operating margins. That is software-level profitability in a service business.
It is, and it's driven by what we call incremental margins. It's a beautiful thing to see in a business. Once Paychex has built the software platform and has the service center up and running,
the fixed costs are already paid for.
Exactly. So adding one more employee to an existing client's payroll costs them almost nothing.
So if a client, say a restaurant, hires a new barista, Paychex charges a little bit more for that new record, but their own costs basically stay flat.
Precisely. All that new revenue drops almost straight to the bottom line. That's where their gross margins are over 80%. It is an incredibly efficient machine. However,
I was waiting for it. There's always a catch.
there is always a catch. And the catch is cyclicality. We call it the legacy liability.
What does that mean?
It means that because they focus so heavily on SMBs, often companies with fewer than 50 employees, they are fundamentally tethered to the health of the U.S. economy.
Right. We all know that small businesses are the first to fold in a recession. They have less of a cushion.
Exactly. So Paychex has a client retention rate of about 82%. Now, at first glance, that sounds okay, but if you compare it to enterprise software, which is usually 95% plus, it's noticeably lower.
So they're losing almost 1 in 5 clients every year?
They are, but here is the key nuance. Most of that churn is involuntary. It's not clients getting mad at the service and leaving for a competitor. It's clients going out of business.
The business literally disappears.
The business just ceases to exist. So Paychex can have perfect service and still lose a client because the economy turns south.
So if the economy catches a cold, Paychex gets the flu.
Or at least a very bad cough, yeah. And that leads us directly to why the stock has struggled recently. Investors are worried about a slowing economy. So to really understand if management can handle that kind of pressure, we need to look at their track record. We have to look at history.
Let's do it. Let's transition to section 2, the historical deep dive. I love this part because it really shows you the DNA of a company. The framing question here is, does this management team have a track record of adapting and evolving, or are they just resting on their legacy success?
It's a story that you can really break down into distinct eras. We have to start with the founder era, B. Thomas Golisano, from 1971 all the way to 2004.
The legend. The guy who started it all with a few $1,000s.
He established the entire model. Back then, ADP was the big dog in payroll. But they completely ignored small businesses. They thought there was no money in it.
They thought the paperwork was too much hassle for too little of a fee, right?
Exactly. Golisano saw that gap and said, I'll take the small guys. I'll take the ones no one else wants. He built this culture of high-touch service through his branch model and a real sense of fiscal conservatism. He ran it lean.
And he proved that that niche was actually a goldmine.
He did. But then we hit era 2, the stumble. This was under Jonathan Judge from 2004 to 2010.
And this is where the business model got its first real stress test, the Great Recession.
This is the era that bears point to today when they argue the company is too cyclical. In fiscal year 2010, at the trough of the recession, revenue actually fell 4%. Net income dropped 11%.
That's rare for a company like this. I mean, these are businesses that are supposed to just grow through everything.
It was a real shock to the system, and client counts stagnated. It proved definitively that Paychex is not immune to macro shocks. The narrative on the street was that they were stuck to $2 billion in revenue. They couldn't break through.
What was the lesson from that period?
The lesson was clear. You cannot just rely on the number of people employed in America. If unemployment spikes, you shrink. You have to find ways to offer more value per client to increase the revenue you get from each business that survives.
So they needed a turnaround. And that brings us to Martin Mucci.
Era 3. The turnaround from 2010 to 2022. Mucci is widely considered the hero of the modern Paychex story. He took over a stagnant company and set a really audacious goal.
The $3 billion by 2016 goal.
Yep. I read that he even handed out Christmas ornaments with $3 billion printed on them to all the employees to keep it top of mind.
He rallied the troops.
He did. But more importantly, he pivoted the technology. This was the critical move. He shifted them from being a service bureau, which was basically people on phones filling out forms for clients, to being a true SaaS company. Software as a service.
And he backed that up with investment, right? I think he tripled the IT headcount.
Yes. They stopped hiring as many service reps and started hiring developers. They launched Paychex Flex, which was their modern cloud-based platform. They launched mobile apps, real-time payroll. They completely modernized the tech stack.
And it worked.
It worked. They hit the revenue goal. And that foundation he built was crucial for navigating the next crisis, COVID-19.
That PPP loan moment was huge for them.
It was. When small businesses were absolutely desperate for cash from the Paycheck Protection Program, Paychex stepped in. They used all the data they already had on their clients' payroll to help them apply for those loans almost instantly.
It must have built immense loyalty.
It really did. It proved that the digital plus human model works. You have the tech to make things easy, but you also have the human support when a crisis hits.
And that brings us to the present. Era 4. the current era. John Gibson took over as CEO in 2022.
And Gibson inherited a very strong ship. Mucci left the company in great shape, but he faced a new, more strategic challenge: market saturation.
They'd already won the small business market.
Pretty much. There are only so many small businesses in the U.S. They had conquered the under 50 employees market. To keep growing at a meaningful rate, they had to move upmarket.
And that leads us directly to the elephant in the room, the massive acquisition that has Wall Street so divided.
Let's get into it.
Section 3, the strategic pivot, the Paycor acquisition.
This is the most critical part of the current investment thesis. Without understanding this deal, you can't have an opinion on the stock. In 2025, Paychex acquired Paycor HCM for $4.1 billion, all cash.
$4.1 billion. That is a huge check to write for a company known for being conservative. So the big question, was this a brilliant strategic move, or was it what Peter Lynch would call diversification?
Well, let's look at the specifics of the deal first. Paycor is a company that specifically targets the mid-market. We're talking companies with 50 to 1,000 employees.
A segment where Paychex has historically been weak.
Exactly. This was a clear gap in their traditional portfolio. They were great at the small stuff, but they struggled to keep clients as they grew larger. If a client grew to, say, 200 employees, they would often outgrow Paychex Flex and leave for a competitor like Paylocity or UKG.
So the bull case seems pretty clear. They expand their total addressable market, their TAM, and they plug that leak in the bucket.
That's the core of it, yes. And then there's a cross-selling opportunity. Paychex has these great high-margin PEO and insurance products that we talked about. Paycor didn't really have a strong offering there.
So the idea is to sell Paychex insurance and benefits to Paycor's existing software clients.
Exactly. Plus, they are targeting $80 million in cost synergies by fiscal year 2026 from things like eliminating redundant back-office functions and combining data centers.
Okay, that all sounds good on paper. But there is a bear case, and it's loud.
It is. And it starts with the price tag. First, the valuation. They paid about 8 times revenue for Paycor.
Ouch. 8x revenue. That's a high-growth tech multiple for a company whose growth was already slowing.
And that's the real problem, the deceleration. Before the deal was announced, Paycor was growing its revenue in the mid-teens, which is pretty good. After the deal, post-integration, that growth has slowed to mid-single digits.
That is a massive red flag. Why the slowdown? What happened?
It could be a number of things. Integration distraction is a big one. When you merge 2 large sales teams, merge 2 different tech stacks, it's incredibly distracting for everyone involved.
So people take their eye off the ball.
Potentially. Or it could just be a tougher market for mid-sized software. But whatever the reason, Wall Street is very cautious. We saw a number of analyst downgrades in January 2026, citing an inhibited ability to reaccelerate.
So the fear is that they bought a growth asset just as it stopped growing. They bought at the top.
Precisely. And the integration risk is real. If management spends all their time and energy trying to fix Paycor, do they neglect the core small business machine that generates all the cash?
Okay, so as of right now, fiscal year 2026, how is it actually looking on the ground? What are the numbers telling us?
Well, the top-line revenue is up about 18% year over year, but that's mostly just from bolting on Paycor's revenue. That's inorganic.
You're just buying the revenue.
You're just buying it. The organic growth, the growth from the existing Paychex business is stuck in the mid-single digits. That's the number to watch. Margins were initially diluted by the acquisition, but management has guided that they'll recover to about 43%.
So the jury's still out. This is the big question mark.
Very much so. This is the gamble that the current CEO, John Gibson, has made. If he pulls this off, Paychex becomes a full-stack HR player that can serve a company from 1 employee all the way up to 1,000. It's a huge win.
But if he fails?
If he fails, they burn $4 billion of shareholder cash on a declining asset, and his credibility is shot.
Okay, that's a lot of strategic risk. Let's move to the cold, hard numbers. Section 4, financial performance and valuation, because ultimately we are buying a stream of cash flows. The framing question here, is the stock priced like a dying utility or a mispriced compounder?
Let's start with what you get paid to wait, the income. This has a classic dividend aristocrat profile. At the current price of around $105, you are getting a dividend yield of about 4%.
4% is solid. That's competitive with bonds these days, but you get the potential for upside from the business growing.
And it does grow. They raised the dividend by 8% in late 2025. In a world of uncertainty, that's a very strong signal of management's confidence in future cash flows. But you also have to look at the payout ratio.
Right. How much of their profit are they actually paying out?
It's high, It's between 70% and 80%.
Explain why that matters to our listeners. What does a high payout ratio tell you?
It tells you that this is a mature business. They are paying out almost all of their profit directly to shareholders. They aren't hoarding cash to go, build a moon base or start some speculative new venture.
That shows discipline.
It shows incredible discipline. They're saying, we don't need this cash to grow the core business, so here, you're the owners, you take it.
What about the balance sheet? Did that $4.1 billion Paycor deal wreck it?
They certainly took on debt, no question. But the net debt to EBITDA ratio is still in the 1.0x to 1.5x range.
Yeah.
For a business this stable and cash generative, that is very reasonable. They are nowhere near distressed territory.
Okay, that's reassuring. And we have to talk about the float again in this section. They are holding over $4 billion in client funds at any given time.
That is their secret weapon in a high interest rate environment. As we said, interest income jumped 10% in fiscal year 2025. But, and this is a big risk note for anyone thinking about this, if the Fed starts cutting rates significantly, that tailwind vanishes overnight.
It's a direct hit to the bottom line.
A direct hit. So let's talk valuation metrics. The PE ratio is the classic one.
Where is it trading now?
It's trading in the low 20s, around 21, 22 times earnings. And historically, Paychex has commanded a premium multiple. It usually trades at 25 to 30 times earnings.
So it is cheap relative to its own history. How does it stack up against its main competitor, ADP?
It is cheaper than ADP. ADP trades around 25x earnings. The market gives ADP a bit of a premium because they have more exposure to large enterprise clients and a bigger international footprint, which is seen as less cyclical.
So Paychex is seen as the riskier small biz play, and it gets a lower multiple because of it.
That's the logic.
Morningstar seems to be bullish, though, despite that.
They are. They rate it 4 stars, which is their undervalued rating, and they have a fair value estimate of $122 per share. They think the market is being too pessimistic about the macro environment and the Paycor integration.
It really feels like the market is pricing in just GDP level growth, like really slow, boring 2-3% growth forever.
I think that's exactly right. If Paychex can deliver high single-digit growth, which is what management is aiming for with Paycor, then the stock is cheap right now. If they fail and only grow at 2 or 3%, then it's probably fairly priced.
And what's management's own signal? What are they doing with their cash?
They seem to think it's cheap, too. In January of 2026, the board authorized a new $1 billion share buyback program.
$1 billion is a serious number.
It is. They usually only buy back enough stock to offset the dilution from employee stock options. A new, dedicated $1 billion program is a clear signal from the board saying, we believe our stock is on sale, and this is a good use of capital.
Okay, so if you had to give their capital allocation a rating.
I'd say exemplary. Their hierarchy is very clear and very shareholder-friendly. It's 1, organic investment in the business. 2, a strong, growing dividend. 3, buybacks, primarily to offset dilution. And a distant 4, M&A.
With Paycor being the one big recent exception to that rule.
The one big exception, yes. They don't usually chase shiny objects.
Okay, the picture looks pretty solid, but has this one giant question mark. Let's get skeptical. Let's really try to break this. Section 5, risks, forensic review, and failure scenarios. What kills this thesis?
The number one risk, scenario 1, is the macro Achilles heel, a severe deep recession.
We talked about 2009. Revenue actually dropped. That's the proof.
It's the historical precedent. If unemployment spikes from, say, 4% to 8%, Paychex shrinks. The legacy liability is structural. You cannot diversify away from the fact that your core clients are small businesses. If they die, you bleed. It's that simple.
Okay, what's scenario 2?
Scenario 2 is competitive disruption from the low end.
This is the Intuit and Gusto threat. Right?
Exactly. Intuit has QuickBooks, which is the default accounting software for millions of tiny businesses. And it is so easy to just click a button that says Add Payroll inside QuickBooks. Why would you go out and hire a separate company like Paychex?
It's the good enough problem. QuickBooks Payroll might not be as full-featured, but it's easy and it's integrated.
And that's a real threat to Paychex's new customer pipeline. Their defense against this is moving upmarket with Paycor and deepening the moat with full-service HR and PEO.
The idea being that a software robot can't handle a complex sexual harassment claim or a messy firing.
Exactly. You need human expertise for that. Paychex PEO service provides that. That's much harder for a pure software company to disrupt. But the very low end of the market is definitely under attack.
And what's the third major failure scenario?
Scenario 3, integration failure with Paycor.
This is the big one we keep coming back to.
It is. If Paycor's growth continues to decelerate or stalls out completely, we could see a goodwill impairment. That's the scary accounting term for we overpaid for this asset and we have to write down its value on our balance sheet.
And that would crush the stock price and management's credibility.
Absolutely. The key thing to watch here is that synergy target of $80 million. That's a concrete promise they made to Wall Street. If they miss that target, their credibility takes a major hit.
Okay, those are the big strategic risks. Any forensic red flags? We dug through the 10Ks and the footnotes.
We check for any aggressive accounting tricks,
Yeah.
like how they recognize revenue. Nothing aggressive found. Their earnings quality is very high. What you see is what you get. But there was a data breach lawsuit filed in 2024.
Data privacy is a huge deal for a trust-based business like this.
It is everything. Now, there's been no material financial hit from it yet, but it is a major reputational risk. If small business owners stop trusting Paychex with their employees' social security numbers and bank accounts, the game is over.
The whole business is built on that trust.
The entire moat is built on it.
Okay, we have covered a lot of ground. Let's bring it all home. Let's do the recap and outro. What is the summary of the case for and against Paychex?
Let's start with the good. You have a dominant market position in a critical industry. You have a very wide moat driven by high switching costs. You have incredible 40% operating margins. You're getting paid a 4% dividend yield to wait. And they have a history of exemplary capital allocation.
Okay, that's a strong list. Now the bad.
The bad. It is fundamentally tethered to the health of the U.S. economy. There are very real cyclical risks. Organic growth has been slowing. And there is massive execution risk on this huge Paycor deal they just made.
All right, so putting it all together, the verdict. Does Paychex clear our high bar?
I believe Paychex clears the high bar for inclusion in a quality income portfolio.
Okay, so it's a compounder, not a rocket ship.
Exactly. Do not expect this stock to double in 6 months like an AI chip stock. That is not the kind of asset this is. But at around 21 times earnings and near its 52-week lows, the market has priced in a lot of pessimism.
There's margin of safety.
There is a margin of safety here. But, and this is a big caveat, only if you believe the U.S. economy will avoid a deep, prolonged crash.
So it's a skeptical buy. You're not backing up the truck, but it's attractive at these levels.
It's a skeptical buy. You are buying a great house in a neighborhood that might have a rough storm coming. The house itself is strong, but the windows are definitely going to rattle.
I like that analogy. Here is my final provocative thought for you to take away. Paychex is betting its entire future on becoming a mid-market tech player via this Paycor deal.
That's the pivot.
If they succeed, if they integrate it well and re-accelerate growth, the stock will re-rate to a higher tech-like multiple, maybe 30x earnings. If they fail, it remains a slow-growth dividend utility stuck at a low multiple. The next 12 months of integration data, the organic growth, the margins, the synergies, will give you the answer before the rest of the market sees it.
That's the signal to watch. Don't listen to the story, watch the numbers.
Thanks for diving deep with us. We'll see you on the next memo.
Happy investing.